Hi, everyone, and thank you for joining today's webcast. My name is Filip Vukovic, and I'm the head of transfer pricing with KPMG Lower Gulf and the co-head of the Middle Eastern transfer pricing practice. I will be hosting today's session along with my colleagues who I will introduce shortly. Before we begin, I would like to remind you all that the COVID-19 outbreak has been declared a pandemic by the World Health Organization, causing huge impact on people's lives, families, and communities around the world. As the international response to COVID-19 continues to evolve, we're all faced with considerable challenges. We hope that during these unsettling times that you and your family, along with friends, colleagues, and business partners, are keeping safe and well. To make things more complicated, governments around Middle East may shortly face substantial additional pressure due to the recent slump in oil prices. This could undermine recent progress on the economic diversification agendas, which were usually financed through public spending. In these difficult times, one may find itself in need of support to be able to cope with personal and professional challenges that lie ahead. Accordingly, the purpose of this webcast is to share some of the knowledge that we have been gathering over the last few weeks from a tax perspective. And this initial session will be focused on government measures and, more importantly, indirect taxes and related cash flow optimization techniques. One important thing to note, things are moving quickly, and with changes happening on a daily basis, it may be impossible to cover all topics related to your respective business. But our senior tax leaders will cover as much as they can today in order to quickly provide you with a broader perspective on what is happening in the GCC region. We encourage you to get in touch with your local KPMG contacts to discuss your unique situation and identify the best solution going forward. Next slide, please. I will note that this is the beginning of a new series of recorded 45 minutes webcasts that KPMG Middle East is envisaging to roll out on a weekly basis to stay connected for future releases. Your feedback on the end of today's session is highly welcome, and your participation will help us improve in the future. We have also included a number of polling questions for today's session, which you can find in the polling tab in the right-hand side of your player. You will find the first polling question appearing right about now, and we would like to hear your input on the impact that COVID-19 has on your business. I'm joining you today from Dubai, United Arab Emirates, and with the early measures applied by the local authorities, we have been lucky and so far only moderately impacted by the new circumstances. However, we are the part of a global KPMG network and have been in constant contact with our Chinese member firm, which has been dealing with this situation as from January and has passed the valuable lessons learned from their unfortunate experience. If you have technical questions, please use the question mark button and a member of our team will reach out to you. You can also use the chat box in the player. We have a packed agenda today, but we have left some time for questions from the audience at the end of the session. And you may raise questions as we go along with the presentation using the question chat box. Next slide, please. So having covered the administrative part, let me introduce you to today's presenters. We have with us Reese Penning, who is the head of indirect tax for KPMG Lower Gulf, covering UAE and Oman. We have Nick Soverell, who is the head of indirect tax for the Kingdom of Saudi Arabia, and Philippe Noret, who is the head of indirect tax and the head of tax for KPMG in Bahrain. Next slide, please. Today's agenda is as follows. We will go over the results of the poll, which I would like now to close, and take a look at the effects COVID-19 on overall business we're all experiencing. Then we will follow with indirect tax measures implemented across the GCC region. We will also touch base on cash flow optimization techniques. And finally, we will go on with a Q&A session. Now, I would just like to see the result of the poll, if you could close it and give me an overview. Yes, from what I'm seeing, there is an array of disruptions that your organizations are facing. Whether it is the lack of business resilience procedures, where crisis management was not adapt for a crisis of this scale, or supply chain disruptions, or liquidity positions, I see that there is a lot of unrest and a lot of things which are touching your organization. And I'm going to say that the coronavirus is not only a health crisis of immense proportion, it's also an imminent restructuring of the global economy. But it's not the first major crisis many of us have experienced during our career. Thinking back, at the peak of the 2009 financial crisis, a strategy consultant made the following statement. For some organizations, near-term survival is the only agenda item. Others are looking through the fog of uncertainty, thinking about how to position themselves once the crisis has passed and things return to normal. The question is, what will normal look like? While no one can say how long the crisis will last, what we find on the other side will not look like the normal of recent years. Now, these words were written 11 years ago and also ring true today, and if anything, severely understate the reality the world is currently facing. It is increasingly clear that our era will be defined by a fundamental paradigm shift, the period before COVID-19 and the new normal that will emerge in the post-COVID era. Governments are recognizing this by releasing some of the biggest stimulus packages ever seen and proactively implementing tax reliefs. Today, we would like to focus on what some of the GCC authorities have implemented so far in terms of indirect taxes. Next slide, please. Nick, could you give us an overview of what is happening in the Kingdom of Saudi Arabia?
Philip, thank you very much. Good afternoon, everybody. Thank you for joining us. Saudi Arabia has been quite active in terms of not just the kind of broader fiscal measures, but also specifically around relieving taxpayers of some of the cash flow burdens which up until COVID-19 struck in clients' minds. So this is just some highlights of the measures that have been introduced in the last 2 weeks. First up, we have postponement of filing and payment deadlines for both monthly and quarterly VAT returns for 3 months. Effectively, what that means is if you filed your monthly return February by the end of March, or you were expected to, you could now file that return at the end of June and so on for the next 4 returns. The last return being May 2020, which would have been due in June, which can now be filed in September 2020. In terms of quarterly returns, there's only really one return that's caught by these reliefs, and that is the return for the end of March, which would have been filed at the end of April, but now is filed at the end of July. Also, relief has been introduced for importers. So instead of paying import VAT when the goods are cleared, the VAT can now be essentially paid and claimed on the next available VAT return using the reverse charge mechanism. Recovery of this VAT is subject to the normal rules. It's got to be in relation to your economic activity. To the extent it isn't, then clearly import VAT cannot be recovered. Gaza has also suspended fines and penalties for late registration, filing, and amendment of returns. This suspension of fine and penalties also not only applies to the period where the relief is in place, but also where you've made errors prior to this period, started on and around the 18th of March. And so frankly, if you've made any mistakes from the inception of VAT to date, as it is simply saying, well, disclose those mistakes, pay what is due by the 30th of June, and there'll be no penalties and interest and or delay fines levied. We think this is a terrific opportunity for clients to regularize their affairs with no additional cost other than whatever tax is due. As far as we're aware, tax audits, reviews are not suspended. Neither are appeals. But certainly we understand any penalties and fines raised that have not been paid are being suspended in terms of gazette chasing payment. We also understand that the appeal committees aren't sitting, but that is more a kind of what we understand is a logistical issue more than a suspension. So we expect virtual appeals hearings to be set up in due course. Refunds are to be expedited, and requirements to provide bank guarantees also be suspended. When it comes to excise, the Gazette has also allowed postponement of excise filings and payments for 3 months, and that is a huge relief, both in terms of imported excisable goods and goods which are produced in the kingdom. From a customs duties point of view, they've also allowed for postponement of customs duties on imports or specific goods, but this is on application and the provision of a guarantee. The nature of the goods which are subject to the relief hasn't been shared. We're working hard to get more details, and we'll share them with the audience as soon as we have more detail. But at the very least, there's an opportunity to apply for postponement of customs duty payments. And finally, this custom self-correction program noted on the slide, it has been in place for 6 months or so. But now we think it's going to be even more important that taxpayers take advantage of regularizing their customs affairs as well as their VAT affairs, whilst an opportunity to attend to both presents itself. So that's just a run through what's happening from a VAT, customs and excise point of view in Saudi Arabia. I'll now pass over to Philippe Nohre to hear what's happening in Bahrain.
Thank you very much, Nick. Whilst the slide that I will be talking about comes up, I would like to immediately put an important comment there. Especially yourselves, when you are from Bahrain, you might be looking at this slide with a bit of surprise. I'm coming immediately back to it, but first I want to mention that unlike other countries, first of all, around the world, Bahrain has been either very quick or actually very slow in implementing or announcing relief measures. Very quick from the very beginning, some quite important measures have been announced and immediately rolled out. Electricity and water bills are now paid by the government for all accounts for the next 3 months. And importantly, if you are a tenant, if you rent a property, or if you rent indeed also building in which you conduct your business, the municipality fees are also shouldered for the next 3 months by the government. So that has given quite some relief. Hotels and licensed restaurants are waived from applying the 5% government fee, which is also an indirect tax to a large extent. And LMRA fees, so the fees of 30 BD or 300 dirham on any non-expat resident working permits are now also waived for the next 3 months. So there are quite a few elements that have already supported the economy, which are touching the fiscal arena, or actually a waiving of fees which are indirect taxes. On top of that, Bahrain is also paying for 3 months for all citizens that are secured and insured the salaries back to the employer. Now, coming back to what you see on the screen, I wish I would have been in a position at 2:16 p.m. Bahrain time, 3:16 p.m. UAE time, to say that these measures have been officially announced. They have not been, and normally as an advisor, I should now put a long list of caveats, but I've still decided to bring them to the forefront because these will be announced in the next couple of days. Worst case, these will be announced next week and then might be coming into effect as from May into June, July. But the Minister of Finance, His Excellency the Minister, has clearly indicated in internal discussions that such relief measures will be coming into place also in Bahrain. They are quite similar to what Nick has discussed in Saudi. First of all, the deferral of a deadline to file the VAT returns by 3 months and for the next 3 months. This is probably the measure that will already be coming to effect, worst case, subject to announcement next week for April 2020, so for the deadline on the 30th of this month. This would actually go along with the deferral of the payment of the VAT due also, and then in line with these new filing dates. Very important, which will be helping, is on the right-hand side of the slide, top line, suspension, meaning the waiver of fines and penalties during a period of 3 months for any amendments of returns. In other words, given the fact that VAT was introduced in Bahrain on the 1st of January last year and was actually subject to a lot of uncertainties, it is now the time, subject of course to this being announced, and as from the moment that it's announced, to review your VAT positions, your VAT treatment for potentially 2019, and make any corrections which can actually work to your benefit, because this will then be done without any fines, which will again be imposed should this come up at an audit of the MBR at a later stage. MBR will also be stopping active corrective debt recovery for the next couple of months. Will also allow an extension of the deadlines. If you are currently subject to tax audit, you can expect that MBR, your relationship manager, will be in touch to extend the deadline for a response. I'm not saying for 3 months, but at least for some time. And also, if you want to go into an appeal, the strict deadlines will again be extended. The final one, support measure that we expect now in the next couple of days, is an exemption of customs duties on all goods imported in Bahrain and to be sold in Bahrain. That again means a support of about 5% on most of the products that are currently being imported in Bahrain. Now, on the last point, release of a draft corporate tax law. Yes, it might not have been widely circulated, although it was on social and professional media. It is correct that a draft text of a corporate tax law has now been issued and released. The most important one is that this is an initiative from 3 members of parliament in Bahrain. So it will still have a couple of hoops and loops to go through, but the release has not been stopped by the Ministry of Finance nor by NBR. In other words, there is a clear feeder that has been given by NBR to put this into a discussion level. And the Bahrain Chamber of Commerce has indeed been asked officially to comment on this draft corporate tax law. For your information, 5% on banks and financial institutions on the profit made by them, 3% tax on telecoms operators, 2% on the rest of the economy, and a 5% on any revenue and profit, probably profit more, made by subsidiaries abroad owned by Bahraini companies. Again, the date of introduction that is contained in this draft law is the 1st of January 2021. That is pretty unlikely, but it is there, very strange in the current crisis times. It is indeed something that we need to keep an eye on. And then hand over to Rees for UAE and Oman.
Thank you, Philip. So, with respect to UAE, first of all, unlike the measures for VAT announced in Saudi Arabia, or as Philippe has just outlined, that are expected for Bahrain, there is no VAT filing or payment deferral for VAT that has been announced or is expected here in the UAE. As a result, you should be prepared to file and pay as usual. That is, the the return for the period ended 31 March will be due at the end of April in the normal way, and payments are expected to be made at the normal time. No deferral in UAE as of yet. Equally, there has been no FTA comment, nor is any expected around audits being deferred or penalties, etc., being waived. Therefore, our advice to clients here in the UAE is to proceed on a business as usual basis when it comes to VAT. Having said that, there have been some relief measures announced at the Emirate level, in particular Dubai and Abu Dhabi. So the key one, or perhaps the largest or most significant one in Dubai, is a duty refund of 20% of the duty paid. So that is a reduction from a 5% duty rate to 4%. This is a refund and not, as is the case in Bahrain, a waiver or an exemption from duty. So importers would still pay 5% duty and then seek to apply for a refund of that 1% return to reduce to an effective rate of 4%. It will apply for importations from the 15th of March onwards, where those goods are imported into Dubai for domestic sale or consumption. Now, we have no details as yet on the mechanism of how that refund should be applied for, nor indeed for the information that taxpayers will be, or importers will be required to provide to validate their entitlement to a refund. However, you will shortly receive a link to a KPMG self-diagnosis portal on our website, where we'll talk you through how we think these measures will impact, and we can determine whether this would be a useful measure for you to pursue, and then we can assist you to get some of the information ready to go, so that as soon as the mechanism is announced, you can claim the refund that you may be entitled to in a very prompt manner. So, for instance, one of the things we expect will need to be done is some consignment tracking to validate that the goods as imported did end up for domestic UAE consumption or sale. Important to note that that applies to goods imported through Dubai, but otherwise for use within UAE. So it doesn't matter that you're importing through Dubai and then transferring out to another emirate, but it must come through Dubai port because it's a Dubai emirate level measure. Another one on the customs side is a really significant reduction in customs fees by 90%, which of course just makes your landed cost of goods that much cheaper. There will be a 50% reduction in municipal fees for hotels, which will obviously is a welcome relief for that sector, which has obviously been very hard hit by the lack of travellers. And of course, many of you will be aware that Dubai has a number of free zones with their own regulator or free zone operator, and there are reliefs available by the various free zone operators, such as rent holidays, rent reductions, rebates on fees, reductions on fees, and so forth, as well as maybe at the UAE level, some reduction in the cost for work permits. At the for the Abu Dhabi at the Emirate level, perhaps a very significant measure is a credit guarantee scheme operated by ADIO, the Abu Dhabi Investment Office for SMEs, with a 3 billion dirham line of credit to provide business continuity support from a financial aspect, which is a very welcome measure for those affected businesses. There is, as one would expect, a suspension or reduction of various government fees and charges, and where the government is a landlord, there is a rent reduction of up to 20% in the leisure sector, perhaps echoing the high reduction in municipal fees for hotels. So at the municipal, at the Emirate government level quite some significant measures. We are yet to see whether there'll be any federal or UAE level VAT measures. But life continues as normal for VAT taxpayers. For Oman, late last week, similar to as what Nick and Philippe were talking about for Saudi and Bahrain, there was an announcement of a 3-month filing and payment deferral for, I should say that's for corporate income tax, so a 3-month filing payment deferral for CIT, which of course will be welcome for many with not having to pay. Importantly, you can enter into a negotiated payment plan for any outstanding tax liabilities. I should note though that is by application, and you will need to go through an approvals process to validate that your ability to pay your outstanding tax has been impacted by the economic effects of this COVID crisis. There's a 45-day objection deadline under the normal rules for objecting to your corporate tax assessment. That has been waived or deferred indefinitely for affected taxpayers. Again, that key phrase is affected taxpayers, so you will need to validate that the reason you need a deferral on your objection deadline is for COVID-related measures. And perhaps with one eye on the sort of the social impact, if I may say that, of COVID, a very welcome measure is to allow a corporate tax deduction for COVID-related donations. Again, the onus is on the taxpayer there to validate that the donation made went to a COVID-related activity. So, of course, as with most tax measures, the onus is on you as taxpayer to document and validate your position. So at that stage, excuse me, that ends up our roundup of the government level relief measures across the Kingdom of Saudi Arabia, Bahrain, UAE and Oman. Let me move on to some VAT issues, but at this point, Philip, I will hand back to you for our second polling question.
Yes, thanks a lot, Reese, and thank you all for this comprehensive presentation of government measures. Now, as we move on, I would like to open the second polling question to see when do you foresee the current cash flows of your organization may impact the liquidity position. Now, I see that half of you did not respond, so I'm just going to say that the polling question is on the right-hand handle of the program. So if you could select, it would be very useful for us. Also, feel free to use the Q&A button so that you can ask questions that we can discuss at the end of the presentation. Now, I think that a lot of businesses have been impacted, and this is the polling results of the first poll, have provided that there is a lot of impact on liquidity and on the cash position. And there is a lot of need for Treasury to manage resources optimally to be in a position to go through the crisis. I think that, Reese, now if you could guide us to what cash flow issues from an indirect tax perspectives and what are the mechanics that we can apply to help Treasury optimize the cash flows.
Philip, I'll wait for those polling questions to come through, but I imagine that most people will expect cash flow issues to manifest within the next 1 to 2 months if they haven't already. So with one eye on that, cash flow is clearly going to be top of mind, and indeed it's one of the measures, one of the areas in which a tax function or a finance function within a corporate or a taxpayer can really add some value. If we can manage to either A, generate some free cash by either reducing a payment or deferring a payment or increasing a refund, it's a very tangible way that we can deliver back some value to our organisation. So what we'd like to do now is to move to some, if I can say, techniques in which indirect tax and VAT in particular, given that they are that VAT is present in UAE, Saudi and Bahrain, some techniques that you can use to optimize your cash flow position. And I'm using the word techniques because these are not schemes that we are talking about. They are not arrangements. They are simply being aware of what the VAT law says having a look at how that applies to your current commercial arrangements and seeing if there's anything that could be done to optimize the position or the outcomes under the law. What we're really hoping to do here is to highlight where it's worth revisiting some of your operational level arrangements to see if you're getting actually the best timing proposition from a VAT point of view. We'll also look at some of the broader indirect tax management options that might be open to you. So it's important to reference back that we're only talking about techniques available to you under the law. We're certainly not advocating any tax avoidance or evasion schemes, which are clearly both inappropriate and in most cases illegal. So from an output tax side, which is the left-hand side of this slide, what we're looking at there is, broadly speaking, how quickly or when do you need to report and pay the VAT on your sales and your income? Are you recognizing it and therefore paying that VAT too early? Or can you, under the current law, under your current arrangements under the law, or can you, within your commercial constraints, change your commercial arrangements with your customers a little to recognize and therefore pay that VAT later? So where we go from here is that most, like most regimes, and certainly across the 3 countries we're talking about today, where that usually plays out in what's called the date of supply, or sometimes the time of supply for VAT purposes. It essentially tells you where the VAT on your transaction needs to be recognized, in which tax period, usually a quarter or a calendar month. And in most situations, the date of supply is the earlier of either receiving some of the payment for your transaction or you issuing an invoice. So where we get to then is, can we have a look at your commercial arrangements to see if you can delay issuing the invoice? So, I mean, ultimately what we're getting to here is, at a commercial level, can you issue documents to your counterparty, to the customer, that is not yet an invoice for VAT purposes and therefore does not yet trigger the VAT taxing point, the date of supply? So what we're suggesting then is, if the price is still under discussion because it needs to be, for instance, accepted by the customer, or quality needs to be validated, or quantity needs to be confirmed, then from a VAT point of view, if you issue an invoice while those things are still happening, you will trigger your tax point and therefore have to report and pay your VAT. If, however, you can issue a document which is a claim or a notice of intended invoicing, then we would argue that that is not yet an invoice, because it does not evidence an obligation to make a payment. So by issuing some other commercial document which serves much the same purpose, you can defer your taxing point. Another very obvious technique is the, excuse me, the third dot point there. And it comes down to a very simple, let me give you a very simple example as to why this is powerful. By simply delaying the point at which you issue an invoice, can generate a significant cash flow saving by deferring the point at which you need to pay your VAT. So for instance, in the current month, if you were a monthly VAT taxpayer, if you were to issue an invoice to your customer on the 30th of April, you would need to report and pay the VAT on that sale by in your April return, which is due at the end of May. If, however, you were to delay issuing that invoice by 1 day, instead of the 30th of April, you were issuing it on the 1st of May, then you would need to include that sale in your May VAT return, not your April. Therefore, you would be reporting and paying that VAT at the end of June. So by delaying issuing the invoice by 1 day, you can get cash flow shelter or cash flow deferral of 1 month. And I'm sure most corporate treasurers would be very pleased to achieve that. Now, from an accounting point of view, just because you haven't yet issued an invoice doesn't necessarily change your revenue recognition. What we've really done there is just delayed the paperwork by 1 day, so as to achieve a 1 month delay on the VAT recognition. And of course, it could be longer if you are a quarterly taxpayer. Now, the key issue here on date of supply is, when is the invoice issued? And so what we see with a lot of clients is that, particularly towards the end of the tax period, the system will generate an invoice, for instance, on the 30th of April, but it's not sent. That is, it's not issued to the customer until the 1st of May. Now, most people will say, well, if it's in my accounting system in April, because that's when it was generated, I will account for the VAT in April. But as a matter of VAT law, if you have not issued the invoice, you don't issue that invoice until the 1st or 2nd or 3rd of May, strictly speaking, you don't have to recognise the VAT until the May return, the May tax period. So by including it in April, you are recognising it too early as a matter of law, which of course doesn't give you a VAT risk as far as the revenue authorities are concerned, but you are paying your tax too early. So there is an option there just to have a look back through your system to see which invoices were generated but not physically issued until after month end. The other thing that's always worth looking at is many VAT regimes, and particularly here in the UAE, you can have bad debt relief, or if you have paid output tax on invoices issued in the past, there are reductions in the output tax or a credit that is allowed. If the debt has been bad, maybe it's been written off, or you have negotiated a price reduction with your customer. Let's not forget that you can claw back some of the output tax that you had previously paid. And perhaps the final one is to just point out that beyond issuing an invoice, the other taxing point we always look to is when you have received the consideration. And consideration is usually a term very carefully defined in the VAT law. It's not just necessarily receipt of cash, but receipt of something that is consideration. And most VAT laws have provisions which say words to the effect of that a payment received that is in the nature of a deposit, security deposit, or other kind of installment is not necessarily consideration and therefore does not count as the first trigger point for recognising date of supply. So let's have a good look at your contracts, because there may be some contracts that allow you to say, well, that payment received was an initial deposit to secure future performance and is not payment received, therefore does not act as the date of supply trigger point. The other thing that is also always worth looking at is most the VAT laws have some timing rules, which if you have a supply over a period with periodic payments, installments and so forth, you may be able to recognise VAT over the life of the contract, not upfront. We see a number of clients who, because the basic rule is recognise VAT upfront and in full, they simply do so as a matter of course. So we're working with clients to re-examine key contracts, see whether they have been recognising that earlier than they should have and making adjustments when necessary. I suppose the question that I put to all on the call is, are you optimising your output tax position? There's something you can do within the law to defer recognising the output tax, or is there something within the law that you're not applying properly anyway and you're paying your output tax too early? And so that we're working closely with clients to work on that. Now, of course, from a VAT point of view, output tax is only half of the equation. The other very important half of the equation is the extent to which you are entitled to deduct or recover the input tax or the VAT on your costs. And so I'm going to hand over now to my colleague Nick, who will talk us through some ideas for making sure you're optimising your input tax timing position.
I think I won't go through each of the bullet points because we're conscious that we have to leave a little time for questions. So I'll just cover off a couple of key ones. I think one of the most important topics to look at is to what extent you can bring forward your ability to recover input tax by looking at the date the document was received as opposed to the date that the invoice is paid or indeed authorized for payment. Often in large organizations, ERP systems will identify and register invoices as they literally come through the door, but they don't necessarily set up for those invoices to be processed as part of the AP. You've got a mismatch in dates, which could span the end of a period or even longer. So one of the first things we would say to clients is look at the date your invoices AP invoices are received and registered on the ERP system, as opposed to the date when they're actually claimed from a VAT point of view. Understand just how long that lag is, and try and close that gap. It's key to be cognizant of your processes, which means that if your normal process is to only recover VAT, essentially an authorization of the document or payment, and you switch to try and advance the VAT on the basis I've just explained, then you need to be careful you do not double claim the following month. So there's a need to watch, obviously, that potential issue. The other thing we would say to all of our clients, based on the work we've done in Saudi, specifically using data analytics and reviewing ERP environments, is that an awful lot of the ERP environments have not necessarily been configured appropriately, to the extent that tax may not be identified by the system on posting. And that obviously depends on the ERP system and how the operator uses that system. But we've come across many, many examples where input tax simply isn't picked up. Now is a terrific time to use, and I would say use the power of technology, because it is more of a complete review to identify those instances, because there could be substantial amounts of VAT lying there that simply haven't been recorded for recovery. But aren't big enough necessarily to be material in any kind of reconciliation which would have been done. Bearing in mind in Saudi the commitment of Gazette to refund all VAT either underclaimed or overpaid on an expeditious basis, and our recommendation would be to look at these two key elements as opportunities to improve your cash flow position. I'll hand over now to Philippe for some more general comments about cash flow management. Philippe?
Yes, Nick. Actually, what you see in front of you, ladies and gentlemen, is a summary in a couple of boxes of what Reese and Nick just have mentioned. I want to highlight just a few of them which might come on top of it. First of all, as most of you know, all three countries that are being discussed and reviewed here, we do have a VAT refund structure in place for non-resident companies. I do know that this also applies to yourselves, and having now a VAT system in Bahrain, Saudi Arabia and the UAE means that any reciprocity rules, countries in Europe, for example, that only refunding VAT if your own resident country has such a system, these are now being met. So there might indeed be an opportunity, especially before we got into this crisis, when there was a lot of travels, a lot of business meetings abroad, to get also that VAT or GST back. Given indeed the current situation, the outlook on your revenue side may not be that positive for the time being. I'm very sure it's going to be recovering. It also means that you could be looking at switching from monthly to quarterly returns. That may be an advantage if you're in a VAT payable position, because the laws normally do provide rules and regulations around looking backwards for 12 months or looking forwards for 12 months to be able indeed to determine your VAT filing periodicity. On the other hand as well, if you are still quarterly and you are in a VAT recoverable position because you're an exporter, then it might be worth looking at switching to monthly returns and get the VAT indeed quicker back, taking advantage of some of the relief measures or the accelerating measures that have been discussed. Quite a few elements that can be done now as well. I believe indeed most of your staff, if not all of your staff, is working remotely. That might give them more difficulties to work and to access data and information, because even though there may be deferral of a couple of months, you may still need to keep on top of your indirect tax compliance. So the use indeed, as Nick mentioned, of technology, potentially and definitely enhanced by robotics, is something indeed to consider, and quite a few of your business market colleagues are looking to that one. Final one for the financial institutions amongst yourselves, but also everyone who has exempt income and finds themselves with pro rata rules, so you cannot recover all of your VAT. If you are still looking at the general pro rata, meaning a formula based on your total revenue and your exempt revenue, do consider now in looking at specific methodologies. There are other ways that are allowed by the law, and you may indeed be benefiting from these and getting more VAT refund back than under the generalized pro rata rule. Otherwise, we've looked at all of these elements, and I might give now the word back to my namesake, Philip.
Thanks a lot, everybody. I'm just conscious of time, so I'm going to just jump to a couple of interesting questions that we have received. There was one question for you, Philippe, that as a part of the relief measures, that there's going to be an installment plan offered for VAT liability. Do you have any comments on that?
That is actually, I think, and I've seen that this is from my good friend Venkat. The answer is unfortunately quite short. The answer is no. It has not been the case, so I know that it's going around, but the tax authority in Bahrain are currently not allowing for installments on the payment of VAT. It is not part of the relief measures that are about to be released. It will be an all or nothing. You opt for the deferral or you don't opt for it.
Thanks a lot. And Reese, there was a question here that might be interesting for you. It was, what is the procedure and how complicated it is to switch from a quarterly to a monthly VAT filing?
So I can speak for UAE, Philip, but under the provision in the law allows you to request a non-quarter, so calendar tax period, if you can demonstrate that it would reduce the compliance burden on yourself. So what we're saying is that you apply through the FTA portal, preferable to do it through a tax agent such as ourselves, and demonstrate why it is appropriate in your circumstances, which in the instance here, I presume would be because the taxpayer is in a refund position and it'll assist cash flow. But broadly speaking, you need to show why it is appropriate in your circumstances.
Thanks a lot. And I'm conscious of the time. So
just to add that okay. Is not available in Saudi. Law is pretty clear that if you have an over exceeding 40 million real, you have to register on a monthly basis. There's no means of switching to quarterly unless your turnover falls below that number, and then you can only do it on application.
Thanks a lot, Nick. Now, being conscious of the time, we're going to stop with the questions here. I know that there is many that we didn't manage to answer, but we will come back to you via email because we have a list here. I would like to thank Nick, Reese, and Philippe for being part of today's session. I would like to thank all of you for listening in to our session. As I said, we will have another one next week, and you will all get the invitation quite shortly. I would very much appreciate if you could provide your feedback at the end of this presentation, because it will help us to become better. And if you have any requests on any topics that we might cover in the next sessions, please feel free to write us an email. With that, I would thank everybody and close today's session.